Hi, this is Lara at Elliott Wave Stock Market with your end of the week analysis for the trading week ending Friday the 15th. I'm still expecting it's most likely we're going to see some more upward movement. It might end next week. The target at this stage is still just above 2116.48. Let's have a look at the classic technical analysis first. At the daily chart level, and let's make that a little bit bigger. This is a bear market rally until proven otherwise. We've still got a series of lower lows and lower highs. We had another big bear market rally that failed to make a new all-time high, and it was more than fully retraced down to this low. And so far, until proven otherwise, we should expect that the S&P remains in a bear market. From this low to this high so far, we've had about over 40 days of upward movement, and I'm using a McGee trend line here from the first two big swing lows within this upward movement. If this trend line is breached by downward movement, that'll tell us that this trend is over and the next wave down is underway. Before that happens though, look for this trend line to provide support, and the trend is the same until proven otherwise. Short term, the trend is up. We've got some gaps here. This gap here, we can't tell yet if it's a small breakaway gap from the small pennant pattern or if it's going to be an exhaustion gap. If it's closed within a few days, it could be an exhaustion gap. But if price continues on upward for a few more days, it could be a breakaway gap from the small pennant pattern. At this stage, coming with a wee increase in volume for this upward day, that would be what I would expect it is. At this stage, a breakaway gap until proven otherwise. Along the way up, price is finding support about the 13-day moving average. The 200-day moving average for the S&P is now flattening off. It did increase slightly before in the last very big bear market rally, and so if this turns up, it doesn't necessarily tell us we're in a new bull market. Price is finding some resistance about 2080 where it previously found resistance and support, and now I expect it's likely finding support there. I think that this line of support is probably going to hold up that little bit of downward movement that we saw on Friday. For the last 2 days of the week, as price moved slightly lower, volume was slightly lower, and so very short term the volume profile is bullish. As price moved higher, volume increased. As price moved lower, volume was lighter, and so that supports the idea that we're probably going to see more upward movement next week. ADX is also supporting that idea. It's slightly increasing with the positive DX line above the negative. It's telling us there's most likely again a trend, and the trend is up, and it certainly hasn't told us yet that the trend has changed. The positive line remains above the negative line. ATR though is telling us that this movement is weak. Normally with a trending market, ATR is increasing, but from back here when price was at this low all the way up here, ATR has been declining, flattened off here, and it's now declining again. That's not normal for a trend. This trend is abnormal. It's not coming with an increasing range. Range is decreasing. This trend is very weak. On balance, volume quite often gives us a reliable indicator of price direction for a breakout or for the next movement. On balance, volume is constrained within these two purple lines. It broke above this upper purple line, telling us we're going to get more upward movement. It's coming down now. We'll probably find support at that line. That line's really, really close, and that tells me, along with this line of support for price, that we're probably not going to get much more, if any, downward movement Monday, Tuesday. We're probably going to see upward days Monday, Tuesday. So at least short term, the trend remains up. RSI is not yet extreme. It hasn't managed to reach overbought. There's still room for price to continue higher. Stochastics has reached overbought, but there's now strong divergence between price and RSI and price and stochastics. We've got this double divergence here, and from this high back here we've still got divergence with stochastics, and so that tells us that some classic bearish divergence. It tells us that this upward movement is weak. Let's have a look at VIX. VIX has also got some hidden bearish divergence. Back from November last year, 2015, we had a high here. We've got a lower high here for price, but VIX, inverted VIX this is, has made a new high. As inverted VIX climbs, volatility in the market declines, and that's normal with rising price. But what's not right here is VIX has made, inverted VIX has made a new high beyond the prior high of November, but price has failed to do so. So despite volatility substantially declining beyond this high back here, it's unable to be translated to a corresponding rise in price, which would be normal. Price is weak. We've got regular bearish divergence here between VIX and price. This is hidden divergence delineated by the green lines, and here we've got regular bearish divergence. Price has made a new high, but volatility has failed to make a corresponding, inverted volatility failed to make a corresponding new high, and that's more normal bearish divergence. There's quite a lot of divergence at the beginning here. And looking at the bullish percent index for the S&P 500, we've got an overabundance of over-optimism and over-enthusiasm. The percentage of bullish traders now up here is greater than previously in November 2015, yet again, that is unable to be translated into a corresponding rise in price. So we've got hidden bearish divergence there. Again, that's telling us that this rise in price, despite all that optimism, is weak. And now at the end of the week, with a new high from price on Wednesday and Thursday, we've got some classic or regular bearish divergence. Price has made a new high, yet that's failed to see a new high in the number of bullish traders. The AD line, as it advances, more stocks are advancing in the index than declining. Normally, as price rises, it would be supported by breadth. If the AD line is increasing, there's plenty of support from breadth in this rise in price. The AD line is definitely increasing, but what's interesting here is, again, we've got this hidden bearish divergence. As the AD line is increasing substantially beyond November 2015, that increase in breadth is failing to translate to a corresponding increase in price. Price is weak. I've heard it said that some analysts are interpreting these charts, this divergence, as to say that means price has to catch up with the indicators. That doesn't mean that at all. If that's your interpretation, then you're projecting what you hope or want price to do onto these charts, rather than stepping back objectively and looking at what price is doing now. What price is doing now is failing to make corresponding highs, and the only valid interpretation of that is price is weak. Let's have a look at the Elliott wave count now. The bear wave counts first because we're in a bear market. I used a McGee bull market trend line back here, and when it was breached by a close of more than 3% of market value, which was in this week here, that simple trend line told us that the market had changed from bull to bear, and it told us before this downward drop and before this downward drop, for which we were then prepared. Currently, the market is in a bear market, and using again a simple bear market trend line drawn using McGee's approach, that's from that classic technical analysis of stock trends, we should assume that the bear market remains intact until proven otherwise. The 200-day moving average is turning down. Price remains below the bear market trend line. We need to see a breach by a close of 3% or more of market value before that trend line will be telling us that the market has changed from bear to bull. Just because we've got a new high above this point, even if we get a new high above this point, does not tell us that we must see new all-time highs. Back here for this bear market rally, we had a substantial new high, but it failed to make a new all-time high, and this rise was more than fully retraced. Bear markets have deep corrections, particularly in the early stages. If we take a look at classic Dow theory as well, and we use the big swing lows back in October 2014, here's the corresponding big swing low or major low on the S&P. Both the Dow Industrials and Dow Transportation indexes have closed below those prior October 2014 swing lows, and so simple Dow theory is also telling us that we have had a very major trend change. Using Dow theory, it's telling us that the market is in a bear market until it's not. This Elliott wave count expects that we've had a huge trend change at supercycle degree, that we're in a big supercycle C, most likely to subdivide as a 5-wave impulse, most likely at cycle degree, or a big supercycle flat correction for a supercycle wave Y, most likely to be a C wave, but for now, for the first year or two, it doesn't really matter. We're looking for a 5 down. We've got a primary degree impulse, most likely down here. We've got a slightly truncated 5th wave here. That's okay. I have no problem with that. 5th waves are truncated after a 3rd wave that moves too far too fast, and this shear drop here certainly fits the definition, and the truncation is relatively small, so that's fine. We've got a 3-3-5 most likely expanded flat correction at this stage for the bear wave count. This is the best wave count I can see, and all the subdivisions fit absolutely perfectly. The proportions also look pretty good. Flat corrections are usually more time consuming than the impulses that they correct, and this one, when it's complete, isn't going to be enormously more time consuming, but it will be more, and the proportions will look good. Intermediate A subdivides perfectly as a double zigzag, and very importantly, from this high to this low, intermediate B subdivides very well as a zigzag, and it's extremely difficult and problematic from an Elliott wave perspective to see this downward wave as a 5-wave structure. For the S&P, it fits best as a 3, so I'll assume that's what it is, which means intermediate C should be a 5-wave structure up. And what that means is, if we get a new high above A, as I'm expecting is very likely, and we get it with a 5-wave structure up, almost everyone, including Elliottians, is going to be calling for new all-time highs, and they're going to be doing that right before a huge 3rd wave at primary degree falls off a cliff straight after. I think it's very likely that intermediate C will make a new high above A at 2116.48 in order to avoid a truncation. First, though, I expect we'll find some resistance at the bear market trend line. If we don't close more than 3% of market value above that point, that bear market trend line will just be overshot, and it won't be telling us we've had a trend change from bear to bull. For a trend change to be confirmed, I would want to see a new all-time high. Primary 2 can't move beyond the start of 1 above 2134.72. Second wave corrections often are very deep, and when they are very deep indeed, their purpose is to convince us that there hasn't been a trend change, and they do it right before a 3rd wave takes off in the opposite direction, and if this one gets close to the invalidation point, it will achieve that purpose perfectly. Let's have a look at this at the daily chart level, where B ends down here, this point here. From this high to this low, B subdivides perfectly as a zigzag, 5, 3, and extended 5 for the C wave. To the upside, C has to be a 5-wave structure. So far, I expect we have an impulse for 1 that was quite sharp and quick. First waves are often like that. An expanded flat correction for 2, an impulse complete for 3, a triangle, a running contracting triangle complete for 4, and now 5 has to end. I still don't think, although it could be over here, and if this trend channel is breached early next week, I'll consider that, but I don't think it's over here because it would still be quite substantially truncated. Intermediate wave C would have failed to move beyond the end of A, so it would be truncated by, I think, just over 29 points. That size of that truncation is just too big at this stage to be seriously considered. And so I think what's most likely is this is just minute 1 of minor 5. The target is still for intermediate C to end just slightly above the end of A, avoiding a truncation, so that primary 2 is a common expanded flat rather than a very rare running flat. Extend the triangle trend lines out. The point in time at which they cross over often sees a trend change, not always, but often. This trick sometimes works to tell us when the 5th wave out of a triangle ends, but at this stage that time is on April the 19th, and I don't think that's going to allow quite enough time for minor 5 to complete its structure. That looks to be a bit too optimistic now, so I'll be expecting minor 5 to last a few more days, probably to end toward the end of next week, but if it takes even longer, then early the week following, but it is getting pretty close to an end now. Within it, no second wave correction can move beyond the start of its first wave below 2039.74. Eventually, a new low below this invalidation point will provide price confirmation that intermediate C has to be over, because at that stage downward movement couldn't be a second wave correction within the final wave up, and so at that stage we would have had a trend change. We'd also have a clear breach of this channel. Because minor 4 breached the channel drawn using Elliott's first technique, redraw the channel using the second technique from 2 to 4 with a copy on 3. Along the way up, look for downward corrections to find strong support if they get that low at the lower edge of this channel, and once the structure of minor 5 could be complete, a breach of this channel is the earliest indication that we're going to get that we may have had a big trend change. At the hourly chart level, this is the start of minor 5 and the end of that running contracting triangle for minor 4. Here's the lower edge of that blue channel. It should provide final support if minor 5 is incomplete. From here to here, particularly at the 5-minute chart level, I've checked these subdivisions. It all fits perfectly. We have a complete impulse. We may now have a 535 zigzag complete for a second wave. The C wave is an ending contracting diagonal. That's what these trend lines mean. That's an Elliott wave convention. Always draw the trend lines when you're expecting a diagonal that's unfolding. It's still somewhat likely, I think, that minute wave 2 is over here, because I think that that trend line on the technical analysis chart about 2080 and that upper purple line on balance volume are probably going to hold up this downward movement, so that this second wave correction is a lot more shallow than a second wave correction would otherwise be. But if it doesn't end here, then here is the most likely target for a bit more downward movement. It could continue lower as a double zigzag, but that would mean price breaking below support of that trend line at 2080, and it would probably also mean on balance volume breaking below that purple line. But if that happens, which is possible, the target would be 2069.47. I wouldn't expect the 0.618 ratio to be reached in this case, because it would need an overshoot of the lower edge of the blue trend channel. And I don't think that's going to happen while minor 5 is incomplete. If we start to see movement below this trend line, something else might be happening. It could be that primary 2 was over here, but at this stage again I don't think so. The truncation would be too big. And so, short term for Monday, Tuesday, I'm expecting a little increase in upward momentum for a small third wave. Then we'll have a fourth wave and a fifth wave to complete the whole structure, right up to and including primary wave 2. The target just above is intermediate A, so that C avoids a truncation. This is an alternate idea for the bear. We should always consider alternates. That's the correct way to do Elliott wave. Look at as many alternates as you can see in them, rank them in order of probability, so that you're always prepared with a roadmap if the main wave count turns out to be wrong. Sometimes lower probability outcomes do occur and you need to be prepared for it. It's all the same to this point here, and then instead of primary 1 over here, what if primary 1 is incomplete and it's a diagonal? There are only two structures a first wave can be, either a diagonal or an impulse. The first most likely wave count looks at the impulse, and the second, less likely alternate, looks at a diagonal. The diagonal would be expanding, would have a zigzag for 1 and 2, a zigzag for 3, which is bigger than 1, so the diagonal is expanding. The zigzag for 4 is now bigger than 2, continuing with the expanding diagonal, and the trend lines diverge. For this one, the rule for the end of a fourth wave of a diagonal is it must overlap first wave price territory. It can't move beyond the end of the second wave, and so a new high above 2116.48 would invalidate this alternate and provide strong confirmation of the main wave count. I would expect for this idea intermediate 4 most likely to end at this bear market trend line, which should provide really strong resistance. When intermediate 4 is over, then a final fifth wave down would most likely be a zigzag, but could also be an impulse, and it can't be truncated. The fifth wave of a leading diagonal may not be truncated. It has to move beyond the end of 3. Once we know where 4 has ended and 5 has begun, we'll also have a minimum price point for 5 down, because the fifth wave of an expanding diagonal has to be longer than the third wave. I can't calculate that price point for you yet. Leading diagonals in first wave positions aren't rare, but they're not enormously common. Impulses are much more common, and that simply reduces the probability of this wave count. Within leading diagonals, the contracting variety is much more common than the expanding variety, so this relies on a much less common structure than the main wave count does, which relies on an impulse and a very common expanded flat. So for that reason, we have to rank this wave count as a lower probability than the main wave count. What that means is once we get a trend change, if it happens before this price point, both wave counts will be valid. What that means is the main wave count would be expecting a big, strong third wave down. We should prepare for that higher probability. This alternate would be expecting just a fifth wave down to end below 3. At the daily chart level, this is the end of 3 and the beginning of 4, so we could have a 5, 3, 5, the little zigzag nearly complete. It could be over here, but for this alternate I would be expecting for everything to have the right look, for price to come up to touch this bear market trend line. The target is 2098, where C will have 0.236 the length of A, so there'll be a ratio between the two. This channel is drawn using Elliott's technique for a zigzag from the start of A to the end of B with a copy. We're not on the end of A. I've pushed it out to sit on most of these highs. Again, when price breaks below the lower edge of this channel, it'll be the earliest indication that we've probably got the end of this upward movement and the next wave down is underway. I have one bullish wave count in order to consider all possibilities. What if this from this high to this low for this piece of the bear market, what if that's it? What if we're in a resumption of the bull market and we're about to see new all-time highs? This wave count differs from my bear wave count at supercycle degree, and I won't go over that in this video. That's covered in the grand supercycle analysis, and you can access that on the right hand sidebar of the website under categories S&P 500 historic analysis. You'll find grand supercycle in there. This bull wave count sees a supercycle fifth wave unfolding. It has to be a 5-wave structure. It's not an ending diagonal, so the only other option is an impulse, which is more common. Within the impulse, the third wave ends here and the fourth wave begins. When you look at this on the monthly chart, the proportions between cycle 2 and 4 look good. Cycle 2 is a relatively shallow single zigzag, and so to have alternation with the zigzag, cycle 4 would most likely be a flat combination or triangle. But let's consider all possible structures for cycle 4. If it began here and ended here, what structures could it be? It could be a flat correction subdividing 335 because the B wave has met a minimum 90% retracement of the A wave. We could also relabel this WXY. We could see it as a double zigzag or a double combination. I'll discard the idea of a double zigzag for two reasons. It would have an adequate alternation with the single zigzag of cycle 2, but more importantly, double zigzags should have a clear, very clear slope against the prior trend, and this movement from this high to this low, particularly this part of the movement, is mostly a sideways look. This is a clear slope, but with this deep B wave here, or rather X wave if it was a double zigzag, this whole movement does not look like a normal double zigzag. The second zigzag in a double has a purpose to deepen the correction when the first one doesn't move price deep enough. To achieve that purpose, the X wave is usually shallow and the Y wave usually ends substantially beyond the end of W. In this case, what would be wave Y ends only about the same level, only a little bit below what would be wave W. And so I would not want to try and label this a double zigzag. It would meet Elliott wave rules, but it wouldn't be a normal looking double zigzag. It doesn't have the right look. What if it's a double combination? We could see this as a flat X zigzag. You can't see this as a flat because there's no correction within it. That could be a B wave that is more than 90% the length of what would be the A wave. But this does meet that definition. We could have a 335. This B wave is over 90% the length of the A wave, so technically from this high to either this low or this low, you could try and see a flat correction in there. But the problem here is intermediate B is over 90% the length of A but less than 105% the length of A, which would classify this, if it's a flat, as a regular flat. And a regular flat normally has a C wave that's about even in length with the A wave and normally ends a bit beyond the end of the A wave. This one absolutely doesn't do that. It ends substantially beyond the end of the A wave. And so this, although it meets the rules, is not at all what a regular flat should look like. It makes little sense, but you could try and force such a wave count. And so I've relied on seeing this whole movement as a big single flat subdividing 3, 3, 5. The problem here is within the C wave. Let's look at that at the daily chart level. Here's the end of primary B. From this high to this low, if we're looking at cycle 4 as complete and it's a simple flat correction, then the C wave must be a 5-wave structure, and it starts here and it ends here. The problem is this does not subdivide properly as a 5-wave structure. Now again, this meets all Elliott wave rules, but it absolutely has the wrong look. You can't see 1 over anywhere else. Now you could see 2 over here, but then 3 would have a 3-wave look to it and wouldn't subdivide right. The best place to see 2 over is at this high here. So from this low to this high, we have to see a complete corrective structure for a second wave. And the problem here is, again, this subdivides technically as a double zigzag, but again, it doesn't. The second zigzag in the double does not fit the purpose of what it should do for a second zigzag in a double. It should move substantially beyond the end of the first, because the first should not have been deep enough. In this instance, minor y does not even move beyond the end of the first. It doesn't even move at all beyond the end of the first. It's substantially truncated. This would have the look of a running flat. This makes no sense in terms of a double zigzag, but technically that's the only Elliott wave corrective structure to which this will fit into. Neither minor y nor w meet the rules for a flat correction, in that within them, their B waves, both of them are less than 90% the length of the A wave, and so minor y can't be seen as a flat. We can't see intermediate 2 as a combination. It does not meet those rules. So with the problem within this structure, the other third option for cycle 4, which I think has the best look, still doesn't have the right look. What all of that complicated description basically boils down to is, if we're about to see new all-time highs, I have not yet been able to find an Elliott wave count that doesn't have some very major problems in terms of Elliott wave structure. And so what that means is it's unlikely we're going to see a new all-time high above 2134.72 in terms of the Elliott wave count. But if the bull bear count is invalidated, then this will be the only wave count that I would have left, and we would be expecting a continuation of the bull market. The target would be 2,500, where cycle 5 reaches equality in length with cycle 1. For the short term, the target for intermediate 1 to end is 2160, where minor 5 would reach equality in length with minor 1, and the invalidation point short term is exactly the same. The structure of this upward movement as a 5-wave impulse is exactly the same short term as the bear wave count. That's all for me today with your S&P analysis. I hope that all of our members are having a fabulous weekend.